Imagine your money working smarter, not just harder. What if your investments could practically manage themselves, adapting to market changes and your goals, all while you're busy living your life? Well, that future isn't some sci-fi fantasy. It's here, and it's powered by artificial intelligence. Today, we're diving deep into AI-powered financial management and the rise of robo-advisors, your automated path to a potentially wealthier, less stressful future. Stick around, because what you learn could fundamentally change how you approach your finances. For years, professional financial advice felt exclusive, shrouded in complex jargon and often accompanied by high fees. But AI is democratizing access to sophisticated financial tools, making them available to almost anyone with an internet connection. We're not talking about sentient robots plotting market takeovers. We're talking about incredibly smart algorithms that can analyze vast amounts of data, identify patterns, and execute financial strategies with precision and efficiency. At the forefront of this revolution are robo-advisors. Think of them as digital financial advisors that use algorithms to build and manage investment portfolios tailored to your specific situation. Instead of a human advisor making every decision, a sophisticated program takes the reins, guided by the parameters you set. How do robo-advisors actually work? Let's break down the mechanics, because understanding this is key. Onboarding and profile creation. When you sign up for a robo-advisor like Betterment, Wealthfront, or Schwab Intelligent Portfolios, you'll answer a series of questions. These aren't just arbitrary queries. They're designed to gauge your financial situation, your goals, your time horizon, and crucially, your risk tolerance. Are you comfortable with market volatility for potentially higher returns, or do you prefer a more stable, albeit slower, growth path? Example: let's say Sarah, a 30-year-old software engineer, wants to save for retirement. She indicates an aggressive risk tolerance and a long time horizon. The robo-advisor will then recommend a portfolio heavily weighted towards equities, perhaps 85% stocks and 15% bonds. If John, a 55-year-old nearing retirement, indicates a conservative risk tolerance, his portfolio might be closer to 40% stocks and 60% bonds. Algorithm-driven portfolio construction. Based on your profile, the algorithm constructs a globally diversified portfolio. This typically consists of low-cost exchange-traded funds, or ETFs, which are bundles of stocks, bonds, or other assets that trade like individual stocks. These ETFs cover various asset classes, geographies, and market sectors, ensuring broad diversification to spread risk. Automatic rebalancing. Markets fluctuate. Over time, the initial asset allocation the robo-advisor set for you will drift. For example, if Sarah's target was 85% stocks and 15% bonds, and the stock market has a fantastic year, her portfolio might naturally shift to 90% stocks and 10% bonds. This means her portfolio is now riskier than her initial target. A robo-advisor will automatically sell a small portion of the overperforming assets like stocks and buy underperforming assets like bonds to bring her portfolio back to the target 85-15 ratio, maintaining her desired risk level without her lifting a finger. Tax loss harvesting. This is a particularly powerful feature for taxable investment accounts. When an investment within your portfolio loses value, the robo-advisor can strategically sell it to realize that loss. It then immediately buys a similar, but not substantially identical for IRS rules, investment to maintain your market exposure. For example, in a volatile year, Wealthfront might sell an S&P 500 ETF that's down, recognize that loss, and instantly buy a total US stock market ETF. This realized loss can then be used to offset capital gains elsewhere in your portfolio, and even up to $3,000 of your ordinary income each year, potentially saving you hundreds or even thousands of dollars annually in taxes. It's a sophisticated strategy that used to be exclusive to very high net worth clients. So, goal-based planning is something that, honestly, a lot of robo-advisors do really well. They let you set multiple financial goals, and each one can have its own timeline and risk profile. For example, you could have one portfolio that's managed more conservatively if you're saving for a down payment on a house in, say, 3 years, and then you might have another portfolio that's invested more aggressively for something like retirement, which could be 30 years away. The AI actually optimizes each goal independently, making sure your strategy fits the specific needs of each goal. The benefits of AI and robo-advisors are, honestly, pretty impressive. Lower fees stand out as arguably the biggest advantage. While traditional human financial advisors often charge 1% or more of your assets under management, Robo-Advisors typically charge between 0.25% and 0.5%. Over decades, this difference can add up to tens, even hundreds of thousands of dollars in savings, directly impacting your net wealth. Accessibility is another huge win. Most robo-advisors have very low minimum investment requirements, sometimes as low as $0 or $500. This really opens up professional investment management to everyone, not just the wealthy. Then there's automation and convenience. Once you're set up, your portfolio is basically on autopilot. This set-it-and-forget-it approach is perfect for busy professionals or anyone who just doesn't want to spend hours monitoring markets. Objectivity is also key. Algorithms don't have emotions, they stick to the plan, which helps prevent common behavioral biases like panic selling during market downturns or chasing hot stocks during bull runs. Diversification is built in too. Robo-advisors automatically create broadly diversified portfolios, making sure your eggs aren't all in one basket. And don't forget about advanced features. Things like tax loss harvesting and dynamic rebalancing, which used to be premium services, are now pretty much standard. Beyond robo-advisors, AI is making waves in broader financial management. Its influence isn't limited to just investing, it's revolutionizing other aspects of your financial life. Take budgeting apps for example. Apps like Mint or YNAB use AI to automatically categorize your spending, analyze your habits, predict future expenses, and even suggest areas where you can save. No more manual entry. The AI does the heavy lifting, giving you a crystal clear picture of your cash flow. On the security front, banks use AI with incredible sophistication to monitor transactions for unusual activity. If your card is suddenly used in a different country for a large purchase you've never made, AI can flag it almost instantly, often before you even realize it. And when it comes to personalized advice, emerging platforms are using AI to offer more tailored guidance on everything from debt repayment strategies to optimizing insurance, looking at your entire financial ecosystem to provide holistic recommendations. Of course, there are limitations, and it's important to know when you might need a human touch. While AI and robo-advisors are powerful, they're not a one-size-fits-all solution. If you have highly intricate estate planning needs, specialized business ventures, significant real estate holdings, or very unique tax scenarios, a human advisor can offer nuanced advice that current AI models might struggle with. There's also the emotional support factor. In highly volatile markets or during major life transitions, like marriage, divorce, or inheritance, some people simply prefer the human connection and reassurance that a person can provide. And if you're looking for customization beyond standard portfolios, like investing in individual stocks, private equity, or highly niche alternative assets, robo-advisors typically don't offer that level of customization. The key takeaway here is understanding. Even with automation, it's crucial to understand the underlying principles of how your money is being managed. Don't just blindly trust the algorithms. Take some time to educate yourself on their strategies. So, are you ready to embrace the future of finance and let AI lend a hand with your money management? I encourage you to explore platforms like Betterment, Wealthfront, Fidelity Go, or Schwab Intelligent Portfolios. Take a look at their fee structures, understand their investment philosophies, and see how they align with your financial goals. And hey, have you already used a robo-advisor or an AI-powered budgeting tool? Share your experiences and any tips you have in the comments below. Don't forget to like this video, subscribe for more personal finance insights, and hit that notification bell so you don't miss our next deep dive into making your money work smarter.